Hello and welcome. Welcome back, Accounting 201. This is Chapter 9, Long-Term Assets, Fixed and Intangible. Before we get started with the chapter, just a quick recap. We just finished our midterm exam that covered chapters 1 through 8. Most of you did fairly well on the exam. I also want to make one quick housekeeping announcement. As you know, when it comes to homework, after you make your initial submission, when it comes to homework, feel free to go back to previous homeworks and retake them to earn a higher score if you like. So after the initial due date, once you submit it on that initial due date, you can always go back to previous homework assignments and retake them to get a higher score. And you can retake those unlimited times. So please take advantage of that. We call that learning by doing. With respect to quizzes, after you take the quiz by the initial due date, you can go back to previous quizzes and retake those up to 2 times. So each quiz is up to 2 times. So that's just a quick housekeeping note. Feel free to take advantage of that. I think that it will help you with your overall score, because as we see as time goes on, as that overall score changes, it can only help you. Another quick housekeeping note: this week I will be releasing a opportunity for extra credit. The extra credit opportunity will also help you in the job front. How is that? The extra credit is going to be a certification through QuickBooks. The certification will help you to become a certified user of QuickBooks. What does that mean? Well, once you tell a potential employer that you're professionally trained in how to use QuickBooks, it helps you to obtain a position using QuickBooks. Or if you're interested in starting a side business, you can use QuickBooks, right? Most small businesses use QuickBooks, so it really is something that I strongly recommend. And so I will open that extra credit opportunity up, and the way that you'll be able to earn the extra credit is once you go through the training process for QuickBooks, you sit for the exam, and you get your certificate. All you need to do is upload your certificate to the submission area in Blackboard. If you've already earned a QuickBooks certificate, you can upload that, and I'll accept that for the extra credit opportunity. The idea behind this is that it helps to provide you with a wider body of knowledge when it comes to using applications in the workforce. So that's kind of the idea behind it. Most of the students in this course are accounting majors, so that will certainly help you in your prospects moving forward. Okay, so let's talk about long-term fixed assets. Always a fun topic. Okay, as you know, fixed assets include things like property, plant, and equipment. That is the definition of a fixed asset. It's property, plant, and equipment. Those are the descriptive titles that you will typically find in a chart of accounts. Fixed assets commonly have following characteristics. They exist physically, thus we call them tangible. The word tangible means you can physically touch it. That's what the word tangible means. They're owned and used by the company in its normal day-to-day operations to help to generate a profit. And they're typically not offered for sale as a part of normal operations. In other words, the business is not in the business of selling property, plant, or equipment. It's in a different type of business, not that. So, okay. That's fixed assets. As you know, there are costs associated with fixed assets. Costs that may be classified as a fixed asset. Costs that have been incurred may be classified as a fixed asset, as an investment, or as an expense. in other words, costs that are incurred with the purchase of property, plant, and equipment may be classified as an investment or as an expense. We'll talk a little bit more about that. When we classify a cost in the purchase of property, plant, and equipment, we look at two things. The first step is, was it purchased, what we purchased long-lived? In other words, do we expect that asset to last longer than 1 year? If the answer is yes, the item is recorded as an asset on the balance sheet, either as a fixed asset or an investment. As a fixed asset, it's property, plant, and equipment, and we expect to use it in the business to help the business generate a profit. An investment is we purchased the property, plant, and equipment to hold it and then to sell it later. That might happen like if I buy the building next door, but I'm not going to do anything with it. I just don't want anyone living there. And I'll later sell that. That's an investment. It would be a fixed asset if I use that building to help the company generate a profit or generate revenue. So if the answer is yes, then we proceed to step two. If it's no, the item is classified as an expense. So in other words, if the asset that we purchased is not long-lived, we classify it as an expense. In other words, we expect the piece of equipment to last 11 months. Then that would be an expense. Step two. If the asset is used in normal operation, is the asset used in normal operations? If it's yes, we classify that as a fixed asset. In other words, property, plant, and equipment used to help us to generate revenue in the business. If yes, it's a fixed asset. If no, it's an investment. Items that are classified or recorded as a fixed asset include things like property, plant, and equipment. Such assets normally last longer than 1 year and are used in normal operations. Investments that are long-lived are used as in the normal and are not used in normal operations are held for future resale. We call these investments. An example would be I purchased neighboring land in the idea that I might expand my operation. Then I decided not to, so I just hung on to it, and then I sold it later on. That land is an investment. Okay, so doing a little bit of a deeper dive on fixed assets, property, plant, and equipment. So property would be land. The cost of the costs associated with property, plant, and equipment for land, which is the property, would be the purchase price, sales tax, permits, broker commissions, title fees, surveying fees, any type of past due real estate taxes, removing unwanted buildings, grading and leveling. In other words, anything that is associated with purchasing land and all of the related things like taxes and fees and so forth and so on, all of those are costs associated with the purchase of that land. We also have land improvements, which are also costs that will be associated with the land. We include things like, landscaping, fencing, outdoor lighting, paving, parking lots, and walkways, things like that. Plant, which is also known as the building. With the building, there are costs such as architect fees, engineer fees, insurance for the construction, interest on any borrowed money for construction, sales taxes, repairs, reconditioning, modifying, and permitting. All of these are costs associated with the purchase of a building or the construction of a building or modification of a building. And then equipment. Equipment when we purchase equipment, there's sales tax on that, there's freight, installation. If it's used equipment, there's repairs involved, reconditioning. There's insurance on the equipment, assembly, modifying it for use, testing, permits. All of these things are costs associated with equipment. So we need to record all of these costs, and it's typically recorded in the purchase price of property, plant, and equipment. Only cost necessary for preparing fixed assets includes the cost of the asset. And of course, there are other costs that are associated with that asset, but are recorded as an expense because they are not a component of the usefulness of that asset. These would include things like vandalism, mistakes on installation, uninsured theft, damage, or fines from the government for not having the right permits to use certain equipment. All of these we record as an expense because they are not involved in the usefulness of the asset. We have an example here. This company purchased equipment for $12,500. There was freight of $600 incurred for transporting the equipment to the installation site. Installation cost was $1,500, and there was there's a $500 error from the installation that we incurred. So here is the journal entry we make. We debit equipment and credit cash. Now you'll see the equipment came to $13,600. Well, how did we get there? The initial cost was $12,500. There was freight of $600. The installation was $1,500. Then there was an error of the installation. So, as we said earlier, the $500 from the error of installation is not included in the cost, but we do expense it out. So, our equipment, true value of our equipment is the initial purchase price plus the freight plus the installation minus any errors, which got us to $13,600. So we debit $13,600 equipment and credit cash. For that $500 that was an error, we expense that out. It would be an expense. So let's talk a little bit more about the costs. So there are direct costs incurred with the construction of a fixed asset, like a building. Will include things like raw materials and direct labor. These things should be capitalized as a debit to an account called construction in progress or construction in process. When the construction is complete, we take it out of construction in process and put it into the building. So the way the journal entries would look is when we construct the building, as we're constructing it, we would debit construction in progress. When the building is completed, we would credit construction in process and debit our building account. What about leases? A lease is a contract for the use of an asset for a period of time. An example would be is I lease my apartment, which means I am paying to use somebody else's apartment for a period of time. We'll call it a year. With any lease, there are two parties that are in the contract. There's the lessor and the lessee. The lessor is the person or company who owns the asset. My landlord would be the lessor. I am the lessee. I'm the person who is using the apartment granted by the lessor. When leasing an asset, there are a couple of advantages. Number one, the lessee has access to the asset without having to spend funds to obtain financing to buy it. In other words, I pay rent. I don't have to worry about building up a down payment. I don't have to worry about getting a loan through a bank. I just simply pay my rent every month. Expenses such as repairs and maintenance are covered by the lessor. If my refrigerator breaks, it is the responsibility of the landlord to fix it. The landlord is the lessor, the person who owns the asset. The risk of incurring additional cost because the asset becomes obsolete before the end of its useful life may be mitigated. In other words, once something happens to the refrigerator or other appliances, those costs of replacing those are mitigated through the lease. Typically, the way it works is that a lease might cost a little bit more than actually owning it because the cost of the lease covers maintenance and replacement and things like that. So in other words, the landlord makes out a little bit by being protected from the lease being a little bit more than the actual cost of ownership. And that's very standard. What about depreciation? As you know, assets lose their value over time. Over time, fixed assets, with the exception of land, lose their ability to provide services. As you know, land is infinite. Land is infinite. The land that the building sits on can be regenerated. It'll always be there. The dirt will always be there. Okay, that's why I say land never loses value. The costs of fixed assets, such as equipment and buildings, should be recorded as an expense over their useful lives. We basically expense them out over time through the process of depreciation. Recording the cost of fixed assets as an expense is called depreciation. Because land has unlimited life, it is not depreciated. Depreciation is caused by physical and functional factors. Physical depreciation would include wear and tear and exposure to weather. For example, if I have a factory building, that building is constantly exposed to the climate, the weather. The building over time will deteriorate. Thus, it will physically depreciate in value over time. It also has what we call functional depreciation. Functional depreciation is when something becomes obsolete and changes, or there's changes in customer needs that cause the asset to no longer provide services that was intended. For example, I have the building that my company uses. It's exposed to weather, so it has physical depreciation. It also might have functional depreciation where my company becomes too big for the building and I cannot expand the building, so therefore it loses its usefulness to provide its original intention. There are two common misunderstandings about depreciation. Depreciation does not measure a decline in market value of a fixed asset. Instead, depreciation is an allocation of fixed asset expense over the asset's useful life. And so, therefore, we have this thing called book value. Book value is the value of the asset minus accumulated depreciation. And this typically never is in agreement with market value. Market value is something completely different. Depreciation does not provide cash to replace the fixed asset as it wears out. In other words, the asset doesn't provide you with cash to replace it later on. It's like saying, oh, my building is getting older, I'm not taking care of it. The building's not going to all of a sudden start giving you cash, right? It doesn't work that way. So those are some misconceptions when it comes to depreciation. We said a few words that you need to know. I said the word useful life. Useful life is how long we expect the asset to be useful. That's useful life. I gave an example of a dump truck a couple of times. I like that example because it's always useful. A dump truck, on average, will last for 5 years. So therefore, the useful life of the dump truck is 5 years. I purchased the dump truck for $25,000. The dump truck is expected to last for 5 years. If I use this thing called straight line depreciation, which we're going to talk about here shortly, I will depreciate the value of that dump truck for 5 years, each year until it reaches a value of 0, which means it has reached the end of its useful life. We'll talk more about that. There are 3 factors that determine depreciation expense on a fixed asset. One is the asset's initial cost. In my example, the dump truck, initial cost is $25,000. The second factor is the asset's expected useful life. According to the IRS schedule, the dump truck will last for 5 years. And the third thing is the asset's estimated residual value. Residual value is the value of the asset at the end of its useful life. In our example, I'm going to say the residual value is 0. I don't expect there to be any residual value at the end of its useful life. So the formula here for straight line depreciation would be $25,000 divided by 5 years, or $25,000 minus the residual value of 0, which is $25,000, divided by 5 years, gives us a straight line depreciation of $5,000 per year for 5 years. We'll talk more about that when we get to those depreciation methods. Well, initial cost. The initial cost of a fixed asset is the purchase price plus the other costs it takes to obtain the asset. Earlier, we talked about things like shipping cost, insurance cost while it's in transit. These are all costs that are associated with with acquiring that asset. So in my dump truck example, the truck itself costs $25,000. I might have insurance costs to get the dump truck from the dump truck supplier to me. The insurance might be $1,000. So now I'm up to $26,000. There might be a freight cost of $500. Now the value, my initial cost is $26,500. There might be an installation cost of $100. So now I'm at $26,600. And that would be the initial cost for me to get my dump truck and to be able to use it. Another thing we talked about is expected useful life. This is how long we expect the asset to be used for in normal operations. I said that my useful life for my dump truck will be 5 years. It is estimated at the time the asset was placed into service. So if at year 0, I say, hey, listen, that dump truck I expect it to last for 5 years. So 5 years is the expected useful life. The estimate of the expected useful life is based off of industry standards. Well, kinda. The reality is, oftentimes every year the IRS comes out with a schedule known as the Maker's Report, and it kind of gives an outline of how long things typically last. And so we use that as our standard for determining the estimate of the useful life of the asset. Residual value. This is the value of the asset at the end of its useful life. It's an estimated at the time the asset was placed into service. Residual value is sometimes referred to as salvage value. Salvage value. That's what your book will call it. That's what I like to call it. Residual value is also known as salvage value or trade-in value, but mostly we call it salvage value. An example you could use is your personal car. You purchase your car for $25,000. The car will typically last about 5 years. That's $5,000 per year. At the end of the 5 years, the car might be worth $3,000. That $3,000 is the residual value of the car, also known as the salvage value or scrap value or trade-in value. So there's a couple factors for depreciation expense. The difference between a fixed asset's initial cost and its residual value is called the depreciable cost. This is the asset's cost that is allocated over its useful life as a depreciation expense. If a fixed asset has no residual value, then its entire cost should be allocated to depreciation. Earlier, I gave the example of my dump truck. Purchased a dump truck for $25,000. It's expected to last for 5 years. I expect there to be no residual value at the end of that 5 years. In other words, there won't be any scrap value. It'll be totally worthless. I'll just throw it out. So $25,000 minus $0 in residual value divided by the number of years of useful life, in this case 5 years, is $5,000 per year for 5 years. So here's another example. Let's say our company purchased a forklift on January 1st. The initial cost was $24,000. We expected to last for 5 years. It has an estimated residual value of $2,000. Remember, the residual value means the scrap value at the end of the 5 years. So keep this example in mind, because what we're going to do now is we're going to go through straight line depreciation, double declining balance, and units of activity using this example. So jot down these three things. Initial cost, $24,000. Expected useful life, 5 years. Estimated residual value, $2,000. Okay, so here's how it works. A company will typically select one of these three depreciation methods. We have straight line depreciation, units of activity, and double declining balance. These are the three most commonly used depreciation methods. Some companies, you can use more than one, but you can only use one for each respective asset. So for example, if I have a forklift, I might use straight line. If I have a dump truck, I might use units of activity. If I have a building, I might use double declining. In other words, you can use more than one type of depreciation, but you can only use one type for each asset. So let's look at straight line depreciation first. This provides the same amount of depreciation expense for each year of the asset's useful life. Now remember our example for the forklift. How do we calculate straight line depreciation for the forklift? Now remember, it'll be the same amount for each year over its useful life. We take, for straight line depreciation, here is the formula that we use. We take cost minus residual value divided by useful life. The original cost was $24,000. The residual value at the end of the 5 years we said was $2,000. So $24,000 minus $2,000 is $22,000. $22,000 divided by 5 years is $4,400 per year for 5 years total. Lakeisha, does it make sense?
Somewhat. Just listening, processing information.
Great. Awesome. Thank you. Yeah, so if you have questions, just let me know. So this straight line method is probably the most commonly used because it's the easiest to use. Now remember, there really should be brackets up here for cost and residual value. You want to do this top part first. So cost minus residual value before you divide by the useful life. So 24,000 minus 2,000 first gets you to 22,000. Divide by useful life, which is 5 years, equals 4,400 per year for 5 years. So that's straight line. Computing straight line depreciation may be even more simplified by converting it to percentages. Using percentages, we can figure out what percentage of the value we would depreciate each year. So looking at our example, and it's simple. All you do is you take 100% and divide by the number of years in useful life. So using our earlier example of the forklift, if the forklift lasts for 5 years, or the dump truck even, we expect it to last for 5 years. We take 100% divided by 5. 5 is useful years, useful life. That gives us 20%. 100% divided by 5 is 20%. So in other words, we would depreciate 20% of the total, of the initial cost of the asset each year. If it lasted 8 years, it would be 12.5%, 10 years, 10%, 20 years, 5%, 25 years, 4%, so forth and so on. This is just another simple method of converting it by percentage. So every year, at the end of every year, we would generate a journal entry, an adjusting entry for depreciation. The adjusting entry for depreciation at the end of each year would be the following. We debit depreciation expense for that asset, in this case being the forklift, 4,400. We credit accumulated depreciation, 4,400. What you need to know about accumulated depreciation is accumulated depreciation is similar to a contra account. It is contrary to depreciation. It is used to depreciate the asset. Once it fills up, then we take it off of our books. And we'll show you how that looks later on. Accumulated depreciation is called a contra account or a contra asset account. It's because the accumulated depreciation is deducted from the related fixed asset account on the balance sheet. So if you think of your balance sheet, on your balance sheet you have listed out your assets. Forklift, dump truck, building, whatever, right? All of these things depreciate over time. So when we're depreciating them, we are reducing the value on the balance sheet. To do that, we are debiting depreciation expense and crediting the accumulated depreciation account. By doing that, we are reducing the overall book value of the asset. The difference between the fixed asset account and its related accumulation account is called book value. The book value of the forklift at the end of the first year on the balance sheet looks like this. We have equipment, which is our forklift, 24,000. We have accumulated depreciation of 4,400. It's negative here because we are reducing the value of the equipment by 4,400. So 24, but the 24,000 will always be on the balance sheet. But the new item you'll see under assets will be accumulated depreciation. Accumulated depreciation will always be negative. So 24,000 minus 4,400 gives us a book value of 19,600. Lakeisha, are we still good?
Yeah, I'm good.
Awesome. Thank you. Okay, so that's straight line depreciation. Now let's talk about another commonly used method of depreciation called units of activity. It sounds like exactly what it is, units of activity. This provides the same amount of depreciation expense for each unit of activity of the asset.
I have a question.
Yes, please.
So that what's that, accumulated depression? Depreciation?
Yes.
That's almost like a car when you buy a car. It's like they have the market, and then they have, if you drive a lot over 5 years, it's how much it would depreciate. So like the Kelly book value of it, that's like the same thing. Another example.
Yes, that's a wonderful example. Yeah, absolutely. Yep, and so it depreciates based off of, well, there's a couple ways you can depreciate it, but typically it's a car, it's depreciated by units of activity, which is represented by the miles driven.
Okay.
So that's why you'll see the more miles the car has, the less it's worth, because it depreciates based off of the miles driven. So awesome example. So depending on the asset, the units of activity may be expressed in terms of hours, miles driven, or quantity produced. Units of activity may also be called the units of production method or units of output method, depending on what its purpose is. So how do we calculate it? Units of activity. Well, there's two steps. The first step is to figure out the depreciation per unit. So it'll be the initial cost minus the estimated residual value divided by the total estimated units of activity. So this would be like saying, Lakeisha, you gave the car example, so it would be the initial cost of the car minus the residual value of the car, also known as its scrap value at the end of the useful life, divided by the total estimated units of activity. In other words, the estimated miles I can get out of that car. So that'll be the first step. The second step, and I'll show you the forklift example here in the next slide. The second step is to compute the depreciation expense by taking the depreciation per unit that we got from the first step times the units of activity for that period. In other words, the number of miles I drove for that year. So here's how it looks. And this is the forklift example, of course, which forklifts don't go by miles, because I don't know anyone who's driving forklifts for several miles. But they do have an hour odometer on forklifts to determine how frequently the forklift is used. So in this example, we use hours. But in Lakeisha's example, we could use miles for cars. It's the same difference, really. Okay, so in our example, our company has a forklift. It costs $24,000. It has a residual value, also known as a scrap value, of $2,000 at the end of its useful life. We expect that the forklift we can use it and drive that thing for a total of 10,000 hours over its useful life. During the first year, we expect we use that forklift for 2,100 hours. Let's figure out its units of activity. Okay, great. So first step, we got to figure out depreciation per hour. So we take the cost, 24,000, minus $2,000 scrap value, gets us to $22,000. We expect to be able to use the forklift for a total of 10,000 hours before the end of its useful life. So 22,000 divided by 10,000 hours equals $2.20 per hour. Now, Lakeisha, you could do the same thing for your car. Let's say you purchased your car, or the cost of your car, let's say you purchased it at $24,000. We think that the car will have a scrap value of $2,000. This is probably accurate, right? So 22,000. We expect you'll be able to get 100,000 miles out of the car by the end of its useful life. Very typical. So 22,000 divided by 100,000 miles, you're looking at 22 cents per mile of depreciation. Makes sense. Then what you do is you take the depreciation per mile and multiply that by the actual miles driven in 1 year. So in the second step in our example, for our forklift, we take our depreciation per hour of $2.20, and we multiply that by the actual hours that we use the forklift. For that first year, it's 2,100 hours, which means our depreciation expense for that first year is $4,620. Lakeisha, does it make sense? I hope you're saying yes.
Yes, it does. I was trying to think of it from a loan aspect. You know how like you do it, like how you talk about the lease earlier in the chapter, but the same thing as the loan. You know how long you have the loan, and between that, I think they kind of calculate how many miles that you will use on that loan, or even insurance. Like if you're trying to obtain insurance on the car, they'll estimate how many miles you're gonna burn, and that means how much insurance you will have for that particular car.
Yeah, that's 100% correct, and that's typically how that's done. So that's kind of like saying you can figure out the cost per mile of your car based off of the loan amount minus the residual value divided by the total miles you can get out of the car to get you a cost per mile.
Yeah. Okay.
That's exactly right. And then you just multiply that cost per mile times the number of miles you actually drive to figure out the true cost per year.
Okay.
Yep. Same concept. This really is the same concept. Yep. And so the journal entry we would make at the end of the year to record depreciation is we debit depreciation expense, 4,620, and we credit accumulated depreciation, 4,620. And the reason why we do that is to, of course, reduce the value of the forklift for that first year. And we assume that during its 5 years, the forklift will be used the following way. First year, 2,100 miles, or 2,100 hours. Second year, 1,500 hours. Third year, 2,600 hours. Fourth year, 1,800 hours. Fifth year, 2,000 hours. To total the estimated useful hours of 10,000. So that is units of activity. Now let's talk about the third most common method of depreciation called double declining balance. This provides declining periodic expense over the expected useful life of the asset. Now, I'll tell you this. The reason why companies might use double declining balance for an asset, especially one that costs a lot of money, is because they can expense out the depreciation on their tax form. And when you expense out depreciation, you're basically writing off that asset, right? And so by doing so, you're reducing your tax liability. And so, in other words, what I'm saying is companies do this very frequently to reduce their total tax liability, especially for that first year of the asset. So that's why companies use double declining balance. That's the real reason, anyway. Your book might say otherwise, but that's the real reason. Yep. Okay, so go ahead, Lakeisha.
Well, an example of that is now this shot is kind of funny. So, an example of that is to like a job, when you're a full-time employee, they have to pay taxes on you. Instead of hiring you full-time, they'll hire you part-time. That means they don't have to worry about the insurance, paying the insurance on you when you're part-time worker.
That's right.
Okay.
Yeah, no, that's 100% right. But sometimes, and it really depends too, because some companies will purposely hire full-time employees only because they can write off the expense of the insurance in their taxes.
Well, that's what they did in my job. So 2 examples, like one was they kept pushing us to do an HMO instead of the PPO. And we were just like, okay, why are we doing that? And then when they start, breaking down the difference between the plans, they signed into a new plan where we're paying with the PPO, we're paying more out of pocket, more deductible. Like certain doctors, if you go to specialists, and with women, we go to more special because that's our general health.
Sure, yeah.
We had to pay the copay and the deductible and that all in one setting. Yep. And vice versa. We would have stayed with the HMO, the job get a tax write-off, but then we don't have to pay that deductible. The other thing too, what jobs do, they do this thing where they quite won't give you 40 hours. They'll give you like 32 or 36 because it's under a certain amount. They still can consider you part-time because you're not quite making full-time, but they also cannot offer you insurance because of that.
That's right. Yep.
Yeah, okay.
100% right. Yep, that's businesses get real creative on that stuff, and so. But I'm glad you brought up that comparison, because what you'll see in the next few slides is we're going to look at the depreciation models side by side, and we'll talk about those advantages.
Cool things.
Yeah, very cool. Okay, so for the double declining balance, it's a 3-step process. The first step is determine the straight line percentage using the expected useful life. So, in other words, calculate straight line first. That's step 1. Calculate straight line first. Get the percentage. We talked about that in an earlier slide. For example, if we and here's how you do that. Let's say it's the forklift is our example. The straight line percentage is 20%. How do you know that? How do I know that? You take 100% divided by 5, because it's going to last 5 years. 100% divided by 5 is 20%. So step 1 is 20% in our example. Step 2, determine the double declining balance rate by multiplying the straight line rate by 2. Okay, that's easy. We take 20% from step 1. We multiply that by 2. Guess what? That's 40%. So 40% for step 2. Step 3, compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. So for the first year, the book value of the asset is the initial cost. Let's look at it in our example. Okay, our example, the forklift. Initial cost, $24,000. Expected useful life, 5 years. Estimated residual value, $2,000. Step 1, straight line percentage is 20%. How do we get there? We took 100% divided by 5 to get to 20%. Step 2, double declining balance rate. All we do here is we take the straight line percentage and we multiply by 2. That's what makes it double declining. So 40%. Step 3, we take our initial cost times the double declining rate. 24,000 times 40% is $9,600. So the first year depreciation is $9,600. So our journal entry here is we debit depreciation expense, $9,600. We credit accumulated depreciation, $9,600. Now what about the rest of the years? I can already hear you. Dr. B, what about the rest of the years? We got $9,600 for the first year. What about the rest of the years? So glad you asked. Okay, here's how it looks. That first year, initial cost times double declining rate is $9,600. That tells us our book value at the end of the first year is $14,400. How did we figure that out? We took the book value beginning of the year minus the depreciation for that first year to get us to $14,400. Then we go through the steps. Year 2, we have our cost minus the depreciation at the beginning of that year to get us to our book value, $14,400. The book value, $14,400 times 40%. The depreciation for the second year will be $5,760. We got that amount by taking $14,400 times 40%, which tells me the book value at the end of year 2 is $8,640. We got that by taking the $14,400 minus the $5,760 to get to $8,640. And then you continue to do that until you reach the end of the useful life in year 5. The book value at the end of year 5 should be the residual value of the asset, in this case, $2,000. Nice and easy. Okay. So those were the 3 primary methods of depreciation. Now there's a couple of odd things that we need to talk about. Once in a while there might be what we call a partial year of depreciation. Something might have happened to the forklift during one of the years. It happens, or I might have sold it, or it might have broken down and I had to scrap it, or whatever. Life happens. So we still have to account for that partial year of service. Or in some cases, maybe I purchased the asset, I purchased the forklift in the middle of the year, or somewhere along the line. So I depreciate it for part of that year. Okay, so let's look at it from this example. Fixed asset may be purchased and placed into service other than the first month of the year. And so instead of January 1st, I purchased it in March. Okay? In such cases, we depreciate based off of a prorated based on the month that the asset was placed into service. I'm sure you've probably heard that word before, prorated. Something is prorated when an event happens in the middle of the month or the middle of the year or whatever. An example would be prorated rent. Your rent was prorated because you moved in on the 3rd instead of the 1st. Or, something like that, something weird like that. So it gets prorated. Or your cell phone bill was prorated because you started the service in the beginning. Yeah, insurance. Lakeisha mentioned the example of insurance. Insurance is prorated because you started the insurance plan in the middle of the month instead of the beginning of the month. Some weird stuff like that happens. Or you stop service at a certain time. It's weird stuff. But either way, we have to prorate it. So let's look at our forklift example. Let's assume that our forklift was placed into service on March 1st. For the accounting period ending December 31st, depreciation would be accumulated or prorated for 10 months, March 1st to December 31st. Assets may also be placed into service other than the first day of the month. Kind of like looking at our earlier example with insurance or cell phone bill or whatever, right? In such cases, the asset is placed in service in the first half of the month are normally treated as having placed the first day of that month. Likewise, if the purchase happens in the second half of the month, we treat it as being the first day of that next month. In some cases, we would actually prorate it based off of the day, and all you would do is to just divide by the number of days in that month. Under straight line depreciation, depreciation is prorated based off of the number of months the asset is used. So looking at our example of our forklift, let's say we purchased our forklift on October 1st instead of January 1st. The first year depreciation would be based off of 3 months, October, November, and December. First year depreciation would be computed by the following. The annual depreciation, as we know, is $4,400. Initial cost minus residual value divided by 5 years, $4,400. But we didn't use it for the full year, Dr. B. I know. So what you do is you take your $4,400 times the 3 months. So 4,400 times 3 divided by 12, or 3/12, gets you to the percentage for that full year. So 4,400 times 3/12, or 3/12, would be $1,100. Another way of doing it would be to take your 4,400, divide that by 12, and multiply by 3. You'll still arrive at 1,100. What about units of activity for partial year? Units of activity method is used by the activity rate and the activity level for that period. So, if we purchased our forklift on October 1st instead of on January 1st, we would assume that we used the forklift for 400 hours for those 3 months. First, and how we got the 400 hours is we took the 10,000 hours divided by 12. So you take your initial cost minus the residual value, 22,000. 22,000 divided by 10,000 hours is $2.20 per hour. You take your $2.20 per hour times the estimated hours used for those 3 months. We estimated that we used it for 400 hours for those 3 months. So $2.20 times 400 hours, $880 is what would be depreciated using units of activity method. What about double declining balance? So similar to straight line, if the asset's used for part of the year, double declining balance depreciation is prorated based off of the number of months it was actually used. So, looking at our forklift example, if we put it into service October 1st, the first year depreciation will be based on those 3 months of service, October, November, and December. So what do? Well, you follow the same steps. Double declining balance rate, 100% divided by 5 years, times 2 is 40%. That's our double declining balance rate. The initial cost, $24,000, times double declining balance rate, 40%, equals $9,600. Dr. B, we only use it for 3 months. You're right. So you take your $9,600 times 3/12, or 3 over 12, gets you to $2,400. The other way you could do this third step is you take your $9,600, divide it by 12, multiply by 3. Gets you to $2,400. The second year depreciation would be computed by multiplying the book value on January 1st of the second year by the double declining balance rate. So looking at our example, we put the forklift went into service October 1st, and $2,400 was recorded on December 31st. For that next year, or year 2, we take $21,000. How we got there? It's $24,000 minus the first year depreciation, $2,400, gets you $21,600. $21,600 gets multiplied by the double declining balance rate of 40%, which gets us to a second year depreciation of $8,640. I think you follow the same process, just like you learned before for double declining balance method. So that was, one of those weird situations for partial year depreciation. That's one weird thing that happens with depreciation. Now let's look at another weird thing. Let's look at it based off of revising estimates. Sometimes we need to revise estimates because weird things happen. Or maybe we misestimated in the first place. Estimates of residual values and useful lives of fixed assets, they might change due to abnormal wear and tear, or they simply become obsolete. When new estimates are made by management, they are used to determine the depreciation expense in future periods. Depreciation expense is recorded in early years is not affected. So let's look at an example. Let's assume that we purchased a machine. The initial cost of our machine was $140,000. We expect to be able to use that machine for 5 years. The estimated residual value of the machine is $10,000. Remember, residual value is like scrap value. So let's compute straight line depreciation. $140,000 initial cost minus residual value, $10,000. So that gets us to $130,000 divided by 5 years. $130,000 divided by 5 is $26,000. At the end of the second year, say something happens to the machine, I don't know, what happened? End of the second year, the machine's book value is under depreciated cost, which is its under depreciated cost is $88,000. Okay. How we got there? End of the second year. Now, using straight line depreciation, we depreciated $26,000 per year. At the end of the second year, that means we depreciated it by a total of $52,000. Initial cost was $140,000. Minus 2 years of depreciation, $52,000 equals a book value at the end of the second year of $88,000. At the beginning of the third year, the company estimated that the machine's useful life is actually 8 years, not 5 years. It's actually 8 years. Uh-oh. Well, I already recorded 2 years of depreciated expense. Don't worry, it's okay. We can revise. You can't change those first 2 years, but you could change the remaining 7, the remaining 6, or whatever's left, right? So how do we do that? So if its remaining useful life is actually 8 years, and you know that residual value, instead of 10,000, it's actually 8. So no problem, we just need to make some adjustments. So we need to revise our depreciation expense. How do we do that? We take the remaining book value of 88,000, that's the beginning of the third year, minus the new residual value of 8,000, divided by its new useful life, which means for the remaining years, we would actually depreciate it by $10,000. So once in a while, those type of weird things happen. Weird things. Other weird things happen to our assets too, like repairs and improvements. Oh my goodness, repairs and improvements. Once a fixed asset has been acquired, purchased, and placed into service, costs may be incurred for ordinary maintenance and repairs. That's normal. Those just get expensed out in most cases. But sometimes we improve the useful life. We'll talk about it. Only costs that benefit only the current period are called revenue expenditures. Some costs may be incurred for improving the asset, or we call these extraordinary repairs that extend the asset's useful life. An example, Lakeisha brought up a car earlier, okay? So let's say this, Lakeisha. Let's say you have your car, you purchase your car for $24,000. It has a residual value of $2,000. We said its useful life was 5 years. Let's say at the end of that third year, Lakeisha, we replaced your car's transmission, okay? That's an extraordinary repair. It's very unusual for us to replace a transmission. Well, let's say we do that, okay? Instead of the car lasting for 5 years, now we say, hey, you know what? The car's going to last for 8 years because we want to replace the transmission. We extended the useful life of the car. We call these capital expenditures. These are costs that improve the asset or extend its useful life. Costs related to the ordinary maintenance and repairs of a fixed asset are simply recorded as expenses. Such expenses are revenue expenditures are recorded as increased repairs and maintenance expense. These are like minor things, like, oh, the car needed a tune-up. That's just an expense. A tune-up doesn't extend the useful life. It's just an ordinary repair. So we debit repairs and maintenance expense, $300, and credit cash, $300. For extraordinary repairs, after a fixed asset has been placed into service, costs may be incurred to extend the asset's useful life. This is like replacing a transmission on a car. We extend the useful life of the car by doing that. Such costs are called capital expenditures and are recorded as a decrease to the accumulated depreciation account. Again, it's a weird thing, but it happens. For example, the engine on our forklift is at the end of its useful life. We might be able to overhaul or dramatically repair that engine to extend its useful life by 8 years. The cost of doing that is $4,500. The journal entry that we make is we debit accumulated depreciation. What this does is it reduces the depreciation by $4,500. And of course, we credit our cash to reduce our cash by $4,500. Because the forklift's remaining useful life has been changed, the depreciation for the forklift for the remaining balance of that forklift's book value must also be changed based on the new book value of the forklift. Okay, what about other weird things like asset improvements? After the fixed asset has been placed into service, costs may be incurred to improve the asset. Such calls are called capital expenditures, are recorded as an increase to the fixed asset account. For example, the service value of a delivery truck might be improved by adding $5,500 hydraulic lift to allow easier and quicker loading of cargo. In other words, when I first bought the truck, it had a regular lift. Then I said, hey, you know what? Let's try to make our lives easier and replace that existing lift with a hydraulic lift to allow for easier, quicker loading and cargo. This is an expenditure, but at the same time, it also improves the asset overall. So what I do is I increase the value of my delivery truck by debiting the delivery truck account $5,500 and crediting our cash $5,500 to represent the payment of that improvement. Because the cost of the delivery truck has increased, depreciation for the truck will also change over the remaining of its useful life. In other words, we reformulate based off the remaining balance of its useful life. Here's another weird thing that happens. We might discard a fixed asset. In other words, we throw it out, right? If a fixed asset is no longer used and it doesn't have any residual value, we simply throw it out. We bring it to the dump. We throw it out, right? We make it disposed of. We donate it. Something whatever. We get rid of it. The discarded asset and its accumulated depreciation are removed from the balance sheet once we remove it from the business. To illustrate this, let's say we have a piece of equipment that we acquired for $25,000 and it's been fully depreciated over its useful life. On February 14th, the equipment is discarded. In other words, we got rid of it. What we do is we debit our accumulated depreciation account to reduce our accumulated depreciation by $25,000, and we credit our equipment to reduce equipment by $25,000. This represents writing off the discarded equipment. If an asset has not yet fully been depreciated, the depreciation should be recorded before removing the asset from its accounting record. Let's assume that the equipment we have equipment that costs $6,000 with no residual value. It's depreciated at a straight line rate of 10%. The accumulated depreciation balance after the adjusting entries is $4,650. On March 24th, we decided to remove it from service. Maybe it no longer works and we just got to get rid of it, right? But it hasn't yet fully depreciated. So what do? We prorate the depreciation for the remaining 3 months. So we debit depreciation expense for the 3 months, which in this case is $150, and we credit accumulated depreciation for that same $150. How we got there? We took the $600, which would have been the 10% annualized depreciation for a straight line. times 3/12 to represent the 3 months out of that year that were remaining. Discarding the equipment is then recorded by debiting accumulated depreciation, $4,800, debit loss on disposal of equipment, $1,200, and credit the total equipment of $6,000. The loss of the equipment, $1,200, is recorded because of the balance that was remaining for accumulated depreciation, because it was less than the total balance of the equipment. Loss on discarding of fixed assets are reported on the income statement as an expense. Okay, we're almost done. What if we sell a fixed asset? Sometimes we sell fixed assets, because we no longer need it, so we sell it. Or let's say we have that car, we have got Lakeisha's car. After a while, Lakeisha gets sick of her car, she wants to sell it. Okay. The entry to record the sale of a fixed asset is similar to the entry for discarding an asset. The only difference here is that if the receipt of cash is also recorded. If the selling price is more than the book value of the asset, then we record a gain. If the book value is less than the selling price, then we record a loss. Here's an example. Let's assume that the equipment purchased at a cost of $10,000 with no residual value is depreciated using straight line of 10%. The equipment is sold for cash on October 12th after 8 years of its useful life. The balance of the accumulated depreciation is $7,000. The entry to update the depreciation for the remaining 9 months is as follows. We debit depreciation expense $750. We credit accumulated depreciation $750. Why $750? Well, $750 was the original cost, $10,000, times 9/12. Why 9/12? Because we used it for 9 out of the 12 months. Times the 10%, or towards the straight line rate, to get $750. After the current depreciation is recorded, the book value of the asset becomes $2,250. That's the original cost minus $7,750 of total accumulated depreciation over the 8 years. We sold it. We sold the asset, the equipment, for $2,250. So we debit cash $2,250. We debit accumulated depreciation $7,750, and we credit equipment to remove it from the books $10,000. To record the sale, we debit cash $1,000, debit accumulated depreciation $7,750, we debit loss on the sale of equipment $1,200, and we credit the equipment $10,000. To record the sale of the asset if it was a gain, we debit cash $2,800, we debit accumulated depreciation equipment $7,750, we credit equipment $10,000, and we credit gain on the sale of equipment $550. Okay. A couple more weird things and then we're good. What about natural resources? Some businesses own natural resources such as wood, which is also known as timber, minerals, or oil. Natural resources. Characteristics of natural resources mean it must be naturally occurring, it can be removed for sale, and can be removed and sold for more than 1 year. An example would be an oil drilling company. They extract oil from the earth, which is naturally occurring. They remove it from the earth and then they sell it. Another example would be timber. They harvest a forest that naturally grows for its wood value. They remove the wood from the land and they sell it. Another example would be a company that does mining. They remove mines like diamonds or other minerals from the earth that naturally occur for sale, and they do it for more than 1 year. Natural resources are classified as a type of a fixed asset. The cost of natural resources includes the cost of obtaining and preparing it for use. Natural resources are harvested or mined from the earth and then sold. A portion of their cost is debited as an expense called depletion expense. Depletion is determined by the following. Step 1. We first determine the depletion rate. We take the cost of the resource and we divide that by the estimated total units of the resource. Step 2, we multiply the depletion rate by the quantity extracted from the earth during the accounting period. We take the depletion rate times the amount of the resource we remove from the earth to get the depletion expense. Here's an example. We have a company involved in mining. The cost of the mineral deposit is $4,000. The estimated total units of the resource is 1 million tons. We can mine 90,000 tons in 1 year. Depletion rate is the total cost of the resource divided by the estimated units. Cost of the deposit is 400,000 divided by 1 million tons is 40 cents per ton. That's our depletion rate. Second thing we do is we take our depletion rate and we multiply that by the tons mined during the year. 40 cents times 90,000 tons is $36,000. Our entry that we make at the end of the year is we debit depletion expense, $36,000. We credit accumulated depreciation, $36,000. You would typically see something like this on like a mining company or an oil company or a wood company. That's their natural business, right? So you would see these types of entries on those types of companies' books. Okay, few more weird things and then we're done. Intangible assets. We talked about tangible and intangible. Tangible means you can physically touch it. There are some things you cannot physically touch. We call these intangible. Long-term assets that are used in the operation of the business that do not exist physically, we call these intangible assets. These may be acquired through innovation, creative activities, or simply purchasing the rights from another company. They include things like patents, copyrights, trademarks, and goodwill. Accounting for intangible assets is very similar to that of fixed assets. There's a couple differences though. One is called amortization. First we determine the initial cost, then we determine the amortization, which is the amount of the cost to transfer the expense. Amortization results from the passage of time or a decline in the usefulness of the intangible asset. What about a patent? Manufacturers may acquire exclusive rights to produce and sell goods that have unique features. We call these patents. Such rights are granted by patents. The patent office here in DC grants patents for the use to produce goods that have unique features. It's basically a government protection, right? The rights a patent typically lasts for about 20 years. A business may purchase patents from other companies, or it may obtain its own patents through a development process through research and development. The initial costs of the purchase price of the patent include things like legal fees and other associated costs, we debit these to an asset account. It's usually called a patent asset account. The cost is written off or amortized over time throughout its useful life. Patent's useful life is 20 years. Patent costs $1 million. $1 million divided by the 20 years. That's the amortized amount each year. Patent amortization is normally computed by a straight line depreciation method. Amortization is recorded by debiting the amortization expense and crediting the patent account, which is a separate contra asset account, usually not used for an intangible asset. Here's the example. We have a company that purchased a patent for $100,000. It will not expire for 14 years. Its remaining useful life is estimated to be 5 years. So we take the $100,000 divided by 5 years to get $20,000 per year for the next 5 years. We debit amortization expense for patents, and we credit our patents account. So in other words, it's very similar to straight line depreciation. Companies that develop their own patents through research and development costs are usually recorded as the current operating expenses for the period in which they are incurred. Two more weird things: copyrights and trademarks. Copyrights are exclusive rights to publish and sell literature, art, and music. Copyrights are issued by the federal government through the Copyright and Patent Office. Copyrights typically last for about 70 years, beyond the original author's death. The cost of copyright material include the cost of creating the work, plus any other costs for obtaining the work. Copyrights that are purchased are recorded at the purchase price. Copyrights that are amortized over their estimated useful life. Trademarks. Trademarks are protections for things like names, terms, or symbols that are used to identify a business and its products, such as Coca-Cola. That's a trademark. That's a trademark name for a company. Most businesses identify their trademark with a little R next to it. Under federal law, businesses can protect their trademark by registering them with the Trademark and Patent Office for a period of 10 years, and then renew them for every 10 years thereafter. Unlike a copyright, legal costs for registering the trademark are also recorded with the asset. If a trademark is purchased, the purchase price of that trademark are recorded as the asset. In such cases, the costs of the trademark are considered to have infinite useful life, and therefore they are not amortized. They are only renewed every 10 years. Goodwill. Goodwill refers to an intangible asset of a business that is created from such favorable factors such as location, product quality, reputation, and managerial skills. It's not very common, but it's used once in a while. Under general accepted accounting principles, goodwill is recorded only if it's objectively determined by a transaction. An example would be the purchase of a business at a price in excess of its fair value. The excess is recorded as goodwill and is reported as an intangible asset. Unlike patents and copyrights, goodwill is not amortized. However, a loss should be recorded if the future prospects of the purchased firm becomes impaired. This loss will be normally disclosed in other expense section of the income statement. For example, let's say this face card company determined that $250,000 of goodwill created from the purchase of another company is impaired. They would record the following journal entry. We would debit loss of impaired goodwill, $250,000, and credit goodwill, $250,000, to remove the goodwill from the book. For reporting purposes, on the income statement, depreciation and amortization expenses should be reported separately or disclosed in a note. Depreciation of methods are used. We should also tell people what depreciation method we're using. Right? That's obvious. On the balance sheet, each class of the fixed asset should be disclosed. Related accumulated depreciation should also be disclosed. Fixed assets may be shown at their book value. If there are many classes of fixed assets, a single amount may be represented on the balance sheet with a separate note. Fixed assets may be reported under the descriptive caption for the property, plant, and equipment. These are just kind of like general stuff that happens on the financial statements that accompany the assets. Intangible assets are normally reported on the balance sheet in a separate section following the asset. Balance sheet of each class of intangibles should be disclosed. Net any amortization. Here's a nice example of what that looks like. Okay, I think we're at the end. Okay, here's a formula that's good to know. It's called the fixed asset turnover ratio. It measures how effective our assets are in helping us to generate sales. To calculate fixed asset turnover, we take our sales divided by the average book value of fixed assets. The higher ratio, the better. To figure out the average book value of fixed assets, you take your beginning fixed assets plus ending year fixed assets divided by 2 to get the average. So in this example, for McDonald's, we take the sales divided by the average fixed assets to get a 1.1 ratio, which is pretty good because it's relatively high. It's above 1. Okay, Lakeisha, are there any comments, questions, concerns I can help you with Chapter 9?
Just I need to read it again. But can you go over the outlook thing again about at the beginning?
Sure. Are we talking about the estimates for?
No, I'm talking about something you was talking about the not the outlook, but the QuickBooks.
Oh, QuickBooks. Oh, yeah, of course. Yeah, so QuickBooks. QuickBooks is accounting software that is used by 80% of businesses, small businesses within the United States. I am providing an extra credit opportunity to all students in this course. The extra credit opportunity is for you to earn a free certificate from QuickBooks to certify that you know how to use QuickBooks. The extra credit opportunity will be for you to earn that certificate through a small series of training. And you can upload your certificate to the classroom, and I will provide you with extra credit points.
Okay.
So that's just kind of an extra credit opportunity. But don't worry too much about it. I'll disclose that in an announcement probably within the next few days.
Oh, okay. Yeah, I was trying to figure out when would you put the information so we can do the training.
Yep, in the next few days.
Okay, cool.
I'll organize everything so it's logical and step by step kind of way.
Okay.
Cool. Good question. Anything else? Or are we good?
We good.
All right. Sounds good. Well, I hope you have a great night. I appreciate you joining me. You're the only one that joined me tonight, but I'm glad that you did because you asked really good questions along the way.
Oh, I'm good. Hopefully everybody's out there voting. That's all. I did early voting.
Exactly. Sounds good.
Yeah.
I mailed my ballot out a few weeks ago. So.
Oh, did you mail it or did you drop it in the box?
I put it in my mailbox.
Oh, Lord.
Yep. Well, I got an email saying it was counted, so.
Oh, okay, great. That's good. Okay.
I hope that's
as long as you got that, because some people saying they mailing stuff out, they're not getting nothing back.
Oh, really? Yeah.
Uh-huh.
Yeah, I did mine as soon as I got it. I didn't want to waste any time.
Yeah.
But I appreciate you coming and spending some time with me tonight. And I hope everything is going well with you. And I'm looking forward to the next couple of next few weeks, and we'll wrap up the semester.
Alrighty.
Yeah. Okay.
Thank you.
Well, I appreciate it, and I hope you have a good night.
Have a good one. Thank you.
All right. Thank you. Take care.
All right.
All right.
Bye-bye.
Bye.